welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss the housing market and why it matters both for household finances and the broader economy. For most families, a home is more than just where they live. It's typically their largest financial asset, their biggest monthly expense, and their primary source of debt. And from a broader economic perspective, housing is deeply connected to consumer confidence and economic growth. Over the next few minutes, we'll walk through where home prices stand today, how real estate fits into household wealth across generations, and what current debt levels tell us about the health of the consumer. First, let's look at where home prices are today. Despite mixed housing activity in recent years, average home prices have remained near record highs. The Case-Shiller indices, which track home prices nationally and across the largest U.S. cities, have climbed steadily over time. The last meaningful national declines occurred during the 2008 housing bust and briefly in 2022 when interest rates rose sharply. Those are a few key reasons prices have stayed elevated. Many homeowners locked in low mortgage rates before 2021, which has kept a lot of potential sellers on the sidelines, limiting supply. At the same time, consumer balance sheets have remained relatively healthy, with wage gains supporting spending even amid concerns about inflation. That said, affordability remains a real challenge for many buyers. The 30-year fixed mortgage rate currently sits at around 6.3%, well above the sub-3% levels seen in 2020 and in 2021. This means the monthly cost of buying a home today is significantly higher than it was just a few years ago, even for buyers with substantial down payments. Next, let's talk about how housing fits into household wealth more broadly. As this chart shows, real estate is an important component of net worth across all generations. For older Americans, home equity often represents decades of accumulated wealth. Baby boomers, for instance, hold over $19.5 trillion in real estate, making up roughly 24% of their total net worth. For Gen X and millennials, this ratio is even higher. Of course, these generations have had less time to pay down their mortgages as well. This has real implications for the broader economy. When home values rise, homeowners tend to feel more financially secure and often more willing to spend, which supports economic growth. Similarly, housing plays a significant role in financial plans. Focusing on these assets and liabilities rather than on stock market volatility can often make more sense. Housing often plays a major role in inflation. Shelter costs make up roughly 1/3 of the consumer price index, making them one of the most closely watched components by the Federal Reserve. The persistence of elevated shelter costs has been one reason inflation has been slower to come down to the Fed's 2% target, even as prices of goods have come down meaningfully. Finally, while housing is the largest asset on most household balance sheets, it's also the largest source of debt. This chart shows household and consumer debt levels. The difference is that household debt includes mortgages, while consumer debt does not. Debt service levels are healthy compared to where they were in 2008. However, they have been climbing as monthly payments make up a larger share of incomes. So, for long-term investors, the housing market is a useful lens through which to understand the health of the consumer, the path of inflation, and the broader economic cycle. At the same time, when it comes to our own finances, it's important to understand the role of the housing market in our financial plans. We hope you found these insights helpful. If you would like to discuss the housing market or how it connects to your financial plan in more detail, please don't hesitate to reach out. We look forward to speaking with you.